In this edition, we look at two very different countries with two different challenges for this year, the US and China. And I sit here with Felix Brill, the Chief Investment Officer of VP Bank. Felix, what's going on in China? We see the economy falling, equity markets are coming down, we see wild swings in markets. Is that an opportunity for investors?
Not yet. I mean, it's quite challenging in our view. I just returned from a trip to Asia, including Hong Kong and Singapore. And to everyone I was talking to had kind of the same view currently on China. It's really hurting, the real estate crisis, and that the Chinese stock market fell by kind of 30% last year doesn't help either. From a valuation point of view, of course, that looks now interesting, but we all know that a cheap valuation can always become even more cheap. I think what's now going to be very important is that we see a kind of a trigger for sentiment, for better sentiment. That could be if the Chinese government adds or announce additional stimulus measures.
Let's turn to the US. Could it be that VP Bank has turned a bit more optimistic about the US economy?
Yes, indeed. It's quite the opposite to the view in China. We've seen quite some good news and data recently. For instance, if you look at the January labor market report, it was very strong. Almost 360,000 new jobs were added. On top of that, the December figures were also revised upwards, and it almost seems like there's a re-acceleration in the labor market. And that is very important because the US economy relies heavily on private consumption. And the formula here is very simple. If you have more jobs, then we have more consumption.
Have financial markets not priced in the soft landing scenario already?
Yes, indeed. Not only a soft landing, it seems almost like a moon landing. But on a serious note, I think from here, the upside surprise potential is limited. And on top of that, if you look at the technical indicators, they also call for bit of caution. We are moving into thin air. If you take, for instance, the recent spike in the stock price of Meta, that is extreme. That could be also dangerous. Could be also a spike then or way to the downside. And against this backdrop, increase in volatility is likely, and therefore we remain underweight in US equities.
How important is the economy with regards to the US presidential election?
It's the economy is stupid, as a former advisor of President Bill Clinton once put it. And there, of course, it's very simplistic, but there's some truth to it. The better the economy is doing, the higher the chances that the incumbent is going to be re-elected. And from that perspective, Joe Biden and the Democrats actually could sit back and relax, because looking at the first 3 years in office, they added almost 15 million new jobs. That is a lot. By comparison, if you take the first 3 years of Donald Trump in office, the economy at that time only created 6.5 million, so that's quite a difference.
Thank you, Felix. And that concludes our view of the questions. I hope you'll join us again next time. Goodbye.